Hey, what's up? Today we're talking a little bit about volatility risk, what it is, how to minimize it so that you don't make a lot of mistakes that a lot of beginner investors make. If you're new here, my name is Richard. I'm a yield farmer and an investor, and this channel is mainly about investing, earning passive income, and how to invest into DeFi safely. So let's dive right in here. And like always, this is not financial advice. These are just my opinions and my own strategy of investing. Please do your own research before making any investment decision. So in my mind, it's very helpful to separate these two types of risks. The first one is the volatility risk, and the second is the risk of loss. So just by the name, it's pretty simple to understand. Volatility is how much an asset move up and down by, right? For example, Bitcoin, Ethereum, or even the S&P 500 or the NASDAQ index. We're looking at more volatile asset, but the risk of loss is actually quite low, right? If you believe that crypto adoption is going to grow, investing into Bitcoin, it is still pretty volatile, but the risk of loss is quite low compared to different stuff like altcoins, where you have both a really high volatility risk as well as a really high risk of loss. And if you compare with different assets like bonds, for example, they have actually really low volatility risk. It's not very volatile at all, but the risk of loss is actually really high if you zoom out and are investing into bonds for the long term, right? The reason why bonds have a high risk of loss is because oftentimes bonds are not able to generate enough returns to even cover inflation. That's why a lot of us are in crypto in the first place. We want our investments to outpace inflation, right? So just because an asset is not volatile doesn't mean that it does not have risk or is a great long-term investment, right? I personally prefer assets that are very volatile but have a lower risk of loss because this actually gives us more buying opportunities, right? If Bitcoin goes down by 50%, as a long-term investor, you should actually be happy because then you could buy a ton of Bitcoin at a cheaper price. So let's focus on this volatility risk for this video. And the most powerful and simple way to actually eliminate this volatility risk is to use a dollar cost average strategy. And I wish I had done this much sooner. I should have been buying Bitcoin regardless of the price and Ethereum as well. If I pull up the Bitcoin weekly chart here, you can see that the price action sometimes is quite volatile, right? But if you're dollar cost averaging, you're getting an average price. A pretty good long-term average price measurement is the 200-week simple moving average. You can see that if you bought Bitcoin every single day for the last 200 weeks, which is about like 4 years here, your average cost would be around $53,000. So even if the Bitcoin price is quite volatile, you are still likely in really nice profit. The current price is about 2x of this average price. Of course, your cost basis could be much lower if you time the market a little bit by buying more aggressively when the prices are cheap. And then just keep dollar cost averaging even if the prices are high. So the reason why I personally dollar cost average Bitcoin even when the prices are high, because I know that over the long term, I'm actually getting roughly this average price, right? Of course, if Bitcoin cracks down really hard, it's a great opportunity to buy more Bitcoin, but you never know the future. If Bitcoin just keeps drifting up over time and the 4-year cycle kind of breaks, then you're not going to have really great buying opportunities, right? That's why it's very helpful to dollar cost average for longer term investments. And when I say long term, for me personally, it's more than 10 years. It's around like 20 to 30 years for really long term investment. So if you believe in like $1 million Bitcoin, then buying now is not a big deal, even though based on the historic price, it's considered a little bit more extended, right? And this works the same way for different assets like Ethereum. For example, if you had been buying Ethereum for the last 200 weeks here, you would have an average cost basis of 2,000 something dollars. And this is not even including the staking, or if you're earning yield with like a concentrated liquidity pool, right? Then your cost basis would be even lower. And if you guys use like the different strategies that I share in this channel, it's going to help you lower your cost basis even more. But the idea here is we're not trying to time like the perfect bottom for these longer term investment. We're getting an average price by dollar cost averaging in. And then if you want to take profit, you could also consider dollar cost averaging out. So for your mid to short term investment, it could be tempting to keep holding on for like the ultimate high, right? I still believe that Ethereum is going to reach at least $7,000 to $10,000 this cycle. I don't know when that's going to happen, but I believe it will get there eventually. But if you bought some Ethereum below like $2,000, then securing some profits now is a good idea as well, right? So you don't have to actually hold all the way up, hold all the way down on every single investment. So you can start like layering out, for example, at 4K, you take some profits off. At 5K, you take some profits off, 6K, 7K, so on and so forth. So that's the dollar cost average strategy. It's pretty simple, but very powerful, especially for longer term investment. And the second strategy that I want to share with you guys is the 50-50 strategy. And this is really helpful if you guys are yield farming and you're trying to get into a good entry. You could try this 50-50 strategy. So we actually don't know when an actual bottom is going to occur because we can't tell the future, right? For example, if you want to deploy stablecoins into an ETH to USDC pool, maybe your first entry was around $2,500, right? And this is actually a pretty good entry already because you can see after a few months, prices did recover. So even if you had a $2,500 entry on ETH to USDC, by deploying some stablecoins, you are still likely in really nice profit right now. But let's just say you want to be a little bit more cautious. Maybe you're deploying 100K, right? You're putting 50K here at $2,500. And if the price keeps moving lower, let's say 1750, you do another deposit there. So when you split up your entries, what you're going to get is somewhere of an average price that is between the two entries, right? We don't have to calculate the average price in this example because I'm just sharing the concept, but this is going to allow you to get a better entry. And even if you did not get this entry, for example, back here, the prices actually did not dip that low, right? So you would have missed the lower entry, but even here, you're going to still be in profit. So that's a way to kind of remove some of the market timing risk by not deploying all of your capital at once, right? And this works the same exact way with like crypto to crypto pools. Different pools, like for example, if you guys are yield farming Solana to ETH, you could be deploying once at let's say 0.06, right? Because you thought that was the bottom. But then if the price do go lower, you could deploy once again at 0.04. And then you're going to have an average price of roughly 0.05, right? So that would have been your average price if you split up the two entries. So that's the two main strategies that you could use for longer term investing and for yield farming to lower the volatility risk. And of course, you could split it more than the 50-50 as well. You could do like 25% of the allocated capital at a time. Let's say you have a 7-figure portfolio, like $1 million, and you want to deploy half of that into liquid pools, let's say 500K, right? You never actually want to deploy all of that at once. Maybe you start with 10% of your allocated capital, like let's say 50K, then you scale up to 100K, then 150K, and so on and so forth. And the last thing I want to share about volatility risk is that we just want to zoom out, right? If you zoom out and look at these assets from longer time frames, you're going to see that the volatility risk is not a big deal at all. If you're looking at the monthly Ethereum chart, for example, you're going to see that Ethereum's price is quite volatile, but when the prices are cheap, that's a really great time to buy, right? Volatility is not a big deal as long as the asset recovers in price. That's why it's very important to be buying solid assets and not just some random assets if you guys are planning to hold for the next 10 to 20 years or even longer than that. If you guys are looking constantly at the daily chart, like zooming in all the time, trying to think from like a shorter time horizon, it could be very stressful for you, especially if you plan to stay around for a very long time. It doesn't really matter how volatile an asset is as long as they trend up in the future. So that's something to understand. And one thing we could do with volatility as well is we could measure like the max drawdown ahead of time, right? So if we look at Bitcoin on the logarithmic chart, in the 2017 cycle, Bitcoin dropped about 80 something percent from the high. And if we look at the last cycle, Bitcoin did drop about another 77% from the high, right? So Is it possible that Bitcoin pulls another 70% drop? I would argue that yes, especially if you see really bad market condition. So if you measure from the local high, we see a 70% drop is around like $36,000, right? But I personally expect the drop to be a little bit shallower if we do see a big drawdown on Bitcoin. Maybe Bitcoin's price would keep drifting up before we see a huge drop. But even with the local high here, a 55% drop is definitely possible, right? Again, as longer term investors, it doesn't matter if it drops. We should actually be happy if it drops because then we get another chance to buy Bitcoin at a cheaper price, right? One of my biggest regret is just not buying more Bitcoin in the last cycle when the prices are really cheap, simply because I didn't really have that much money to invest. I was very busy with a lot of different stuff, but I still made really good returns from like altcoins, NFTs, airdrops, and stuff like that. But I think especially with institutional adoption of Bitcoin and Bitcoin becoming more and more common, as well as assets like Ethereum, they're definitely great assets to hold for longer term investing. Very similar to assets like gold and stocks. You don't really want to be like swing trading those assets too much, right? If you do trade, it should only be a portion of your portfolio. I personally don't want to be taking that swing with my entire portfolio if the market is topping out. I'm definitely not going to be selling all of my crypto as a longer term investor. So that's the third thing. Try to really zoom out and see that, okay, this is a longer term investment. The asset is very volatile in its nature. You got to realize that. This is also why I don't prefer tight range strategies for yield farming. The volatility is there and the crypto market is still relatively tiny compared to other markets. And one thing to keep in mind if you guys zoom out is that assets can move sideways for a very long time as well. For example, we saw like gold basically move sideways since like 2012 all the way to around like 2019 before it started an aggressive uptrend, right? So just because patterns repeated in the past doesn't mean that it will. And you can see if you go further back, there are like 20 to 30 years where gold kind of just trended down before moving upwards. So does this make gold a bad investment? Not really, right? Because again, the shorter term price movement doesn't matter as much as the longer term trend. And we can look at stuff like the S&P 500 as well. There are periods of time, for example, where the market became really overvalued in the dot-com bubble, where the price took a very long time to break out of that level. But again, the volatility risk is actually an advantage for longer term investor because when there is a lot of downside volatility, we could be dollar cost averaging and actually buy at a cheaper price. And if the prices do go down enough, you could do like larger lump sum buys as well. And I think it's a mistake to look at an asset that has not broken its previous all-time high and just prematurely call it a bad investment, right? Because not everybody is buying at the top as the prices trend down. If you have cash anywhere to buy the dip between this, you will still be in profit even if the prices don't actually break the all-time high. Again, when the prices go down, that's another great opportunity to buy. So that's pretty much it with this video. And again, the three strategy is using the dollar cost average strategy, like into the market, out of the market, mostly into the market for longer term investment and maybe out of the market for the shorter term altcoin plays, right? And the 50-50 strategy is a great way to enter and exit a liquidity pool as well. If you're not that sure about the entry, you could spread it out. And then lastly, we want to focus on zooming out because the worst thing that you could do with volatility risk is to buy the top and then just panic sell the bottom on really solid assets, right? You don't want to be buying Bitcoin now. And then if the price dropped by 50%, you panic sell all of your Bitcoin. So you want to know what you're buying in the first place, zoom out, use all of these strategies. And again, volatility risk, in my opinion, is less of a risk compared to the risk of loss. So you really need to know like which asset you're buying, why you're buying it for the long term, why you're investing into these assets and like their specific time horizons, right? For example, some of my holdings are meant to be like 6 to 12 months long or less. And a lot of my holdings are meant to be, over the next decade or 2 decades or 3 decades, right? And if you want to learn more about yield farming and investing, I have a ton of videos on my channel. And let me know down below if you want me to cover a specific topic. I will go over it if I think that it would help other investors out and if I am an expert in that area. Thank you once again for watching. I'll catch you next time.